What's up, guys? Clint Coons here. And in this video, I'm going to show you how to create tax-free income for life from your rental real estate. Now, when you hear tax-free, you're probably wondering, hey, is this something about depreciation? No, this is something completely different. In fact, not only are you going to get tax-free income generated from your real estate, you're also going to get the IRS to give you a tax break for utilizing this structure. And it's amazing how many people miss this opportunity when it comes to owning real estate. They don't see that there's other options out there. If you don't need the money right now, you want to defer recognition of the real estate income, save it for future generations. There's so many things you can do. Or if you just need tax deductions right away this year, well, here's a strategy. If you have rental real estate, we can get you tax deductions as well with that property. Now, there's one caveat here with this strategy that I have to let you know about at the very beginning. What I'm about to share with you only works if the real estate is debt-free. So if you're watching this video right now, you're like going, hell, all my real estate's encumbered. I'm sorry, this isn't going to work for you now. But if you get to that point where your real estate is unencumbered, there's no debt on it, then you might want to consider utilizing this strategy. So what is the strategy and why would you consider it? Well, here's the way it works. Let's assume that you have a piece of property right here, and this property is worth $300,000. Your cost basis in the property is $100K. Now, you're generating on an annual basis from this property, let's say $19,000 a year. So, how do I take this property that generates $19,000 a year, make this income tax-free, and also get the IRS to give me a tax deduction for $30,000 or more that I can use to offset my rental income? Well, the way to do that is you have to create a very specific type of trust that's called a charitable remainder trust, or what we refer to as a CRT. And so what you'll do is you create this entity, this charitable remainder trust, a CRT right here, and you don't need to sell your property. All you do is you set up this trust. You're going to be the trustee, so you're the trustee right here, and you're going to be the beneficiary. Okay? Now, when I say beneficiary, you're going to be the income beneficiary of the trust. So, you get the CRT set up, and you're going to need a law firm, okay, of course, to set this up for you. A little shameless plug. So, you create the CRT, then you take your property and you deed it. Remember, it's got to be debt-free. You'll deed it into this charitable remainder trust. So I'm going to transfer it in. Now, as soon as I complete the deed, just sign the deed, I've automatically entitled myself to $30,000 or more in tax deductions just by making that transfer into the trust. Now, why do I get a tax deduction for taking this property that I own in my own name and putting it into a trust where I'm the trustee and the income beneficiary? Why is the IRS going to give me $30,000 or more in tax breaks that I can use to offset my income? Well, the reason they're going to do this is because with this type of trust, the way it's set up is that you get to take income from this property for your lifetime. And then when you die, or you and your spouse have both passed away, then whatever remains in the trust, asset-wise, would then be distributed to a charity. And so what the IRS is doing is they're determining what is the future present value of this gift to a charity when you pass away. And typically, it's 10% of the asset's value. So if the asset is valued at $300,000, take 10%, it's $30,000. Now that's the minimum. It could be higher. And there's ways that we can work with these numbers to get you a higher tax deduction. But here's the point. You don't have to sell it. You don't have to do anything. All you have to do is deed it in. You get a tax deduction here. And now when it's in the charitable remainder trust, because the CRT, that charitable, that C word that comes in there, charitable, then all of the income that is collected by your tenants on a monthly basis at $19,000 a year, completely tax-free. Charitable remainder trust will not pay taxes on any of that income. In fact, you could sell that house. Let's say I'm thinking about selling it. If I sold it here, I would have $200,000 in taxable gain. But if I put it into my CRT, I'll still have that taxable gain, but because it's a CRT, charitable remainder trust, I don't pay any taxes on it. So in this case, if I sold it, assuming the, just go basic capital gains rate here, 20%, you would pay $40,000 in taxes. So you would have $260,000 left over. If I did that same deal through a CRT, I pay 0 in taxes, so I have the full $300,000 left over for investment purposes. I mean, this is a great strategy for people who are considering moving from real estate into alternative forms of investing. Maybe you want to get into crypto, or you want to invest in the stock market, you want to do private notes, something like that. But you realize if you sell your property to put it to reposition in a different asset, you're going to pay taxes on it, so you have less to invest. Use a CRT. You'll have it all there. Now, that is one of the huge benefits here. But this right here, I know some of you are looking at that and your eyes have been focused here the entire time. You're thinking, you know, I've got these, right? What are these? Well, some people call them liabilities for a period of time, but they're your children, all right? So you think charity typically starts at home. And if I'm telling you you've got to send it to a charity, you're thinking, well, what about my kids? They're going to be left with nothing. Well, there's a solution for that as well. I mean, I'm not just going to propose you give it all away to the church. I mean, you could if you wanted to, or another charity, but I realize is that you're building a lot of this up to create generational wealth for future generations, and you may not want to let it go outside of the family. I'll show you here in a moment how we can keep it within the family. So don't let this throw you off yet, okay? There's lots of ways to play off of this. So what I want to show you now is that when this property is held inside of the trust and it's collecting income, you, as I stated, is the income beneficiary. We can set up this trust to provide when you're going to receive this income out of here. Now, when you take it out, it is taxable to you. But as long as it's generated inside of the CRT, there's no tax in there. So as long as it's in here, no tax. When it comes out to you, that's when you'll pay tax on the money. So conceivably, you could draft this deal if you said, hey, you know, I've got this great income producing asset right here. I don't need the income for the next 10 to 15 years. I just want it to accumulate. I want to buy more real estate. Transfer that asset into the CRT. Start collecting the income in there. You're not paying anything out to yourself right now. You allow it to accumulate. Then in 15 years from now you start drawing upon it. Kind of sounds like an IRA, doesn't it? Or a 401k plan. Yeah, but it's yours. So that's the way you can set it up. There's lots of different ways you can tweak these entities so you have complete control over when that income is going to come down to your tax bracket. And so that's how it works. So you do get the income when you want it. Now, when you pass away, okay, I stated it goes to charity. Well, the nice thing about this charitable remainder trust is it doesn't have to go to a third-party charity. It could go to your own charity. You could set this entity up whereby when you pass away and your spouse passes away, that the CRT creates a public charity, or it becomes one at that point in time that'll be run by your children. So all of these funds now pass into a charity down here that is run by your kids. Now, when I say run by that, what do I mean by that? Well, let's say the value of this asset when you pass away is $1 million. They'll have $1 million down here, of course, that they're going to have to engage in their charitable purpose, whatever you determine that may be. But in so doing, and so running that charity, they're able to draw a salary. So your kids, your grandchildren could be working for this, have a 401k plan, well, 403b set up off of that entity, and receiving benefits that way by running this charitable organization. So you've kept the majority of the funds inside of the family. Yes, you got to use it for your charitable purpose. Maybe your charitable purpose happens to be affordable housing. Think about that. That stays with the real estate realm. So now your kids and your grandkids are buying real estate inside of a charity, not paying any taxes on it, providing affordable housing to individuals and collecting a salary to do it. You see, using the tax code to your benefit is there if you know where to look. And this is why people say, well, I don't understand how they're finding so much success and they're not paying as much taxes as I am over here. It's because they're using structures like this that allow them to minimize the tax burden. I've used a structure like this before in a botched 1031 exchange. Client screwed it up, so they didn't qualify for the 1031. I said, don't worry about it. Let's contribute it to a CRT, get you a tax deduction, sell it out of the CRT, pay no tax, buy replacement property there, and we'll take the income out through the CRT. Problem solved. There's lots of solutions here. Now, I've had people tell me before, well, Clint, I get it. My kids could run the charity, and you're right, they'll have $1 million down here that they're having, but I really want them to have that lump sum of cash, okay, when I die. No problem. There's another little add-on we can throw onto this venture to ensure that your kids get the value of this asset you're putting into there when you die, tax-free, income tax-free, and estate tax-free. So it doesn't matter what the estate tax is going to be when you pass on. There's another way we can structure this whole deal. So not only do they get all the money down to their charity that they collect income from, but they also get the full value of this completely tax-free. It's as if they sold it and they paid no tax on it. How do we do that? Well, the way we structure that deal is when we set this structure up, this CRT up, I told you, you're going to get a tax deduction. So in my example, you're going to receive a $30,000 tax deduction. Now, depending on your tax bracket, let's say you were in a effective rate of between state and federal 40%. What does that equal? Okay, that's going to equal $12,000 in cash into your pocket. Well, you can take that money right there and you can go out and you can set up another trust. This is called an ILIT, an irrevocable life insurance trust. This video is all about trust planning. Now, you set up an ILIT and you buy a $300,000 policy on your life that when you pass away will pay to your kids, tax-free. So now I've ensured that this $300,000 that, actually that's the wrong number there. The $300K value of that house that I put into the LLC, the CRT that I got to keep, the tax savings alone is going to pay a good down on buying this $300,000 policy. So you buy a term policy, a $300,000 term policy, you fund it with the 12K, you put the 12K in there, that's tax-free going into this trust. That then pays the premiums on your $300,000 policy. When you pass away, that $300,000 goes to your kids because it's life insurance, it's not subject to income tax. And because we use this irrevocable life insurance trust, it bypasses your estate, so there's no estate tax on it. Lots of creativity that can come into creating the structures. If you're looking to sell real estate, if you're looking to just take real estate you currently own right now, again, it's got to be debt-free, and you don't want to be paying taxes on that rental income anymore because maybe you don't need it right now, or you're just looking for some other strategy, consider this type of tool right here. This takes your game to a whole new level. Hey guys, you like this video, hit that like button. Be sure to share it out with other people you may know that have use of using a structure like this. And if you want to talk about it in more detail, go to the show notes, click on that strategy session link, get your own strategy session set up with us at Anderson here, where we'll walk through the numbers with you and show you how it could benefit you in your situation. All right, take care, everyone.